So here's my website. I'm Fotis Papatheofanous from Fotis Trading Academy. I'm a professional trader and portfolio manager. And in 2014, we decided to also create Fotis Trading Academy, where we teach people how to use global macro, how to apply global macro in their trading, so they can start trading just like a real hedge fund for bigger profits. But in this webinar, I wish to do something special. I'm not going to do any marketing. I'm not going to do any sales. I will go straight to the point, and I will show you the importance of using global macro and how to practically extend your profits, how you can have stronger conviction, how you can have less stress, less anxiety. When I said, how can you have strong conviction? I mean, when can you know that this is going to be a big trade? We have the conditions for an important profit. So before I move on, allow me to ask you if you can hear me. All I would like you to do, please, is just say yes in the chat box. And always, please feel free to post your questions, as I said, inside the chat box. So just say yes if you can hear me, if everything is working properly with the sound. Yeah, I see a few yeses there. Okay, excellent. So I will move on. Right. So why shall you use global macro in your trading? And I have done something. I'm going to open my MetaTrader 5, and I will show you something. This is not my system. This is something I picked up from Forex Factory. It's a nice looking trend following system. I'm just going to zoom out a little bit so you can see. Here we go. It is applied on the 4-hour chart. Let me go to time frames, hours, 6 hours. And maybe it looks fantastic to some people. You say, hey, here is the signal to sell. This is red. The stochastic is going down. This has turned negative. I will sell here, place the stop there, and we will just trail it all the way down. Or maybe you are not a trend follower. Maybe you are using a mean reversion system. Again, this is something that I picked on Forex Factory. Great system, sell at resistance, buy at support with the use of an oscillator. You look at this and you think, maybe, oh my God, we can make so much money. This can be applied in any currency pair or CFD you can imagine. Well, let me ask you this then. Why do you think 80% lose money? If you visit any Forex broker, it says at the top, and by law, at least in European Union, they are forced to do this. It says 78, 80% lose money. There is a sad statistic. It says that 90% lose 90% of their capital in 90 days. If there are such wonderful systems, and I'm not sarcastic, right? Very, how to put this, insightful and nice looking systems that potentially can help you. Because let me explain this after having worked in the industry for 20 years. This is not the way to trade. The markets do not exactly behave like this. You cannot base your decisions entirely on a technical system. You are not a quant. There are some people that are quantitative traders, but that is a completely different philosophy, a completely different approach. And they too have very strict procedures. When you are a retail trader, I would say especially a retail trader, you cannot base your decision exclusively on technical analysis. Technical analysis should be the final part of your approach that you use to define your risk. For example, if you decide to buy the euro, where to buy and where is your stop? Here, for example, I would say, okay, I would buy there at the break of a fractal and I will place my stop below. But I'm not basing my decisions because of price action. The number one reason for successful and profitable trading is global macro. So whether I use this or some other pattern over here that you can see, I'm using a plain chart sometimes in my trading. No matter what you use, it doesn't matter. Use any system you want. Elliott waves, trend following, Fibonacci, mean reversion, Bollinger Bands. It doesn't matter as long as it is the last part in your analysis. My decision to buy or sell the euro is based firstly and foremost on global macro fundamentals, nothing else. Allow me to show you the reason why. And I will go here. I have published a book. You can find it on our website. I will show you in a minute with a special offer. If you stay with us till the end, I have a special offer at the end. So this is the book, Apply Global Macro Analysis and Supercharge Your Trading Performance, a step-by-step practical guide. You can see here from the contents, we try to cover everything: introduction to global macro investing, navigating the global macroeconomic environment. I will go here, how to build a global macro framework. So I will go to page 74. 74, here we are, 74. How to apply economic indicators in trading. And I'm not going to discuss theory with you. As I said, today I'm going to be very practical. I will show you a real-time case study. I had highlighted, case study 6. There you go. Inflation data and treasury yields in the United States. Why do you think the dollar appreciated back in 2021? Why did this happen? Let me go here. So I will use TradingView. So bear with me. I'll go to TradingView. And what I do is I go here and I will apply US 10Y, which is the 10-year yield. Do you remember what happened after the COVID? There was COVID in the world and the economy shut down. And after the economy shut down, it reopened again. As the economy reopened, what happened to inflation? Inflation jumped to 9%. Together with inflation, what are you expecting to happen? High inflation, as we explain in the book, market reaction scenario. High inflation, higher yields. Why? Because the central bank, the Fed, the United States Central Bank, wishes to combat inflation. They cannot afford to have 9, 10, 11, 12, 15% inflation. Some people argue that real inflation was even higher. So what I will do is I will click this and I will place DXY. So this is the dollar index. So what do you see? You see there is a correlation, not a perfect one, but a very strong one. Higher yields, higher dollar index. You see here that the yields are peaking just around 5% and they are moving lower. The same thing is happening to the dollar index. So if you are able to recognize the areas that this is going to happen, and how do you recognize this? From macro fundamentals. We were looking to go long the dollar, and again, as I said, use mean reversion, trend following, Elliott waves, Fibonacci. It doesn't matter. It will work. You know why? Because you are on the right side of fundamentals. Yields go up, dollar index move higher as well. This is why the dollar overall against other currencies appreciated. We reached 5%. Inflation is coming down. Can you see what is the most important factor here? Inflation. Inflation is coming down. What happens with the yields? There is no need for yields to be up there. The Fed says maybe even in March 24, they are going to cut rates. So what is the result? Yields down, dollar index down. Let me show you something that is going to be funny. What do you think is affecting the value of the New Zealand dollar, NZD, USD? I'll give you some seconds. What do you think? Let me get rid of the dollar index here. What is affecting the value of the New Zealand dollar? Why does it move like this? You might say, yes, it's the dollar index is affecting this. Correct. This is one leg of the equation. What about the other one? I'm giving you some time to think. What is affecting the Kiwi? What is the main product of New Zealand? Let me type this, it will be difficult to find out. Whole powder milk. New price scale. And can you see that the New Zealand dollar, again, I'm not talking about 100% correlations, but you see the path, what the trend of the futures on whole powder milk is moving together with the value of the New Zealand dollar. My point to you is I don't simply wish to emphasize simple tricks and tactics that you can use. What I wish to stress is that what is happening in the real economy eventually is affecting currencies. So if you can recognize the narrative, and this is what we do, by the way, at Fotis Trading Academy, this is what we teach, global macro. If you can recognize what is going on with the narrative, where is the attention of traders, then you will be on the right path. If we have an event and milk powder futures are coming down because China is not buying as many. The biggest part of the production is sold to China, by the way. So that brings other questions in mind. If China doesn't do well, if they limit imports, this is going to affect the value of the Australian dollar and the New Zealand dollar. But if you know that the trend is lower, then use any system. You see, this is working. I could have used moving averages, Fibonacci resistance, Bollinger Bands, you name it. I go with the trend of economics and I can be right. Another one, because I'm getting asked about the Aussie. The Aussie, let me get rid of milk. We don't need milk here. What is affecting the price of Aussie? It's iron ore futures. I think, no, this is not the correct symbol. This one is the correct. So I need to align. So let me, it didn't work out properly because I should have pressed new price scale. So new price scale, there you go. And now it will be okay. So you can see, can you see that the value of the Aussie, again, is correlated with iron ore prices. Why? Because Australia, the land down under, most of its GDP growth can be attributed to exports of minerals, of iron ore, for example. And this is only one side of this. It's not only what products certain countries export. It is also about interest rate differentials. Let me show you this, for example. Euro, a more popular pair, Euro USD. What about interest rate differentials? This is very important. So let me get rid of this. How am I doing this? Interest rate differentials. What I will do is I will type DE, which is Germany 10Y, German 10-year yields minus US 10Y. So you will see the spread in the yields between the euro and the dollar. And if I click this and I type now Euro USD, what do we see? New price scale. You will see that most of the time there is a correlation between interest rate differentials and the trend of the currency. There is not only one thing that is affecting the currency. It is interest rate differentials, inflation differentials, growth, monetary policy announcements. Every currency has a unique identity. In commodity producing economies like Australia, New Zealand, Mexico, South Africa, commodities is the most important thing. In the UK or Eurozone, it's growth and interest rates. So every currency has a unique identity. We identify this and we explain everything not only inside the book, but we explain everything inside the course. You don't need to be an economist. We explain everything step by step. Case study 7, Chinese economic slowdown and its impact on the forex markets. What do you think will happen if we have a major risk-off scenario? I'm going to move here on my MetaTrader chart. I have Aussie yen somewhere there. Where is Aussie yen? Let me zoom out. This is 6-hour chart. Okay. So what do you think will happen if equities just collapse lower? If there is panic, equities crash, if there is pessimism and very negative headlines, Aussie yen will move together. Let me give you a practical example of what is going to happen, I think, in the first quarter of 24. We are moving towards Christmas, and it's going to be light schedule, thin liquidity, not much price action. But tomorrow we have Bank of Japan decision. On the 19th of December, we have BOJ event, Bank of Japan action. So what do you think is going to happen? Let me go here. Sorry, I was just looking at too many things. Where is my dollar yen? There you go. Dollar yen. This is my chart, and this is going to be my strategy for the first quarter of 2024. I started selling up here as yields were moving lower, but the Bank of Japan is going to be the only one that is going to be quite hawkish as compared to other central banks that they said enough is enough, we hit our peak, and we will just pause for now, and we will not go ahead and increase interest rates. This is why the dollar yen collapsed like this. It is now below, you cannot see this here, but trust me, it is below the 200-day moving average. If I do this object trend line, even if I use some very simple technical analysis, it has broken the trend line to the downside. What am I going to do now? Every time it moves to resistance, I will try to sell. Maybe you use Bollinger Bands or Fibonacci or moving averages or traditional support resistance. It is going to work because we believe we are on the right side of fundamentals. The Bank of Japan is making the right noises. This is what they have clearly expressed, but they have reached the end of the zero interest rate policy. This is why the dollar is moving like this against the yen. Could there be a better currency pair? I think so. And I'm also paying attention to the euro yen. Let me zoom out so you can see. It also broke out closer to resistance. It moves. I'm going to sell. Why do I prefer the euro yen compared to the dollar yen? Because right now, looking at European economic data, the last 2 months, we have contraction of the economy. 2 consecutive months in France, in Germany, in Italy, in all the major economies within the Eurozone, including the UK, in the manufacturing sector, we see a contraction. This is why I think it is very likely that, and provided that the Bank of Japan continues with their policy, I'm looking to sell euro against the yen. And where is my target? Well, my target is at least if I sell, let's say, somewhere there, my target is down here to test the trend line. This is how I approach this. And this offers us success, consistency most importantly, and it allows us to have great reward per unit of risk. I mean, we are going for 3 times we risk the risk we take, then the reward is 3 times the risk, 4 times, 5 times. Sometimes it is even more. So it is very important to look at the data, to look at the fundamentals, and then decide what to do next. So as I promised in this webinar at the beginning, this webinar is about how to identify signals for short-term trading using macro fundamentals. As I explained here inside the book, we are looking at specific economic indicators. You don't need to be an economist developing a trading plan. I will explain this step by step. Let me go here. Okay. And you will understand then why this is important and why this works. The fundamentals of economic cycles. This works because it is based on sound economic principles. characteristics of economic cycles. Here we explain the different phases of an economic cycles: expansion, peak, recession, and trough. So the economy, as it is going through different phases, you can understand it makes sense that the behavior of certain asset classes will resemble the phase we are at the moment. How can we understand whether in which cycle, in which phase we are at the moment? We are doing this by looking at economic indicators, and the economic indicators, they confirm to us what we see based on fiscal policy and monetary policy. So the government or the central bank, based on where we are on the economic cycle, they will take measures. It has to do with fiscal policy or monetary policy. For example, if the economy is struggling, if the economy is doing really bad, what do you think we are going to do? They are going to cut rates. They will offer cheap money in an effort to stimulate the economy. But as they cut rates, it is extremely likely that they are going to make the currency cheaper. Or what happens when it comes to fiscal policy? If they decide, excuse me, that they are going to increase taxes, or what happened with COVID, they are going to provide stimulus. They're going to provide stimulus, and they are going to be, let's say, flexible with taxes because they wish to stimulate the economy. Or like in the case of Greece in 2010, austerity measures. The economy was so bad, there was such high debt, but they had to apply austerity measures. So you see, what I wish to emphasize here is that based on which cycle we are at the moment, we are going to have a reaction: fiscal policy and monetary policy. So how do we understand then the impact so we know how to react in our trading? We start looking at economic indicators, not in absolute terms, but rather the trajectory of economic indicators. Where are they heading? Consumer confidence, for example. Is it moving up? Is it moving lower? What is going on? This is very important. Let me show you this. I wish to go ISM PMI. Sorry, I had the PMI. There you go. Why is this important? You go here, ISM Institute. Everything you need to know about the economy is right here. Leading the industry with reliable economic indicators. Manufacturing PMI. Sorry about this, someone just passed by with very loud speakers. So you report. Agree. What happened? Economic activity in the manufacturing sector contracted in November for 13th consecutive month. Everything you need is right here. The ISM PMI, the manufacturing, is an index that has forecasted every single recession in the United States. It is an index between 0 and 100, and if it is below 50, it means we are moving into contraction territory. So right now it is at 46.7, which means we are into a contraction. 13th consecutive month following a 28-month period of growth. So we are into a period of contraction, and this agrees with what the Fed says, that we are pausing. We are not going to increase rates. Inflation is coming down. So here is the question. So if you are pausing because inflation is coming down, is potentially inflation coming down because of lack of growth? So this is going to be on the mind of every investor, every trader as we move into 2024. And I can tell you the period between now, where they announced that they're going to be quite, well, let's say less hawkish, until the period they go ahead and do the first cut. Usually there is anticipation, there is euphoria in the markets. We have good sentiment, but immediately after the first cut, what are they going to look? Growth. They will look at what is happening with growth. So this is why it is very important to understand the narrative, where we are. It is important to look at the weekly economic calendar and see what is happening on a weekly basis. What announcements do we have? Because if we have a deviation on the data, on economic data, that is much worse or much better than expected, guess what? You are going to have a reaction here in FX. We're going to see a reaction in FX. So to recap, this is what I wish to tell you, how to get short-term signals based on macro data. The easiest thing you can do, the easiest thing, and it's not the only one, but it is an important one. The easiest thing you can do is pay attention to interest rate differentials and pay attention to the Forex calendar for monetary policy decisions, what the central banks are signaling. This is extremely important. This is going to affect sentiment, and it will affect, of course, your trades in the short term as well. The other important thing is recognize what is affecting each currency. Commodity currencies like the New Zealand, like the Aussie, the South African rand, the Mexican peso, are affected by certain commodities, whole milk powder, iron ore, price of gold, price of oil, price of aluminum, and so on. So this is important. If we have a major event and commodities are affected, this is going to affect the currency. If you are trading G10, like euro, pound, Canadian dollar, and so on, it is also important to look at interest rate differentials and monetary policy decisions. Inside the book, this is what we do. We explain everything step by step. You don't need to be an economist. We explain everything. We go ahead and we discuss global macro, how to navigate the global economic environment, and then how to build a global macro framework, how to implement a strategy in their market relationships. And of course, inside the course, we go ahead, we have the courses here. You can just click on them and find out more about it. We explain step by step how to do it and start trading practically like a hedge fund trader. So when I trade, I will say this one more time. Here is the euro yen. What shall I do? Shall I buy because maybe it moves back up again? No. I have a certain outlook about this. I'm only interested to be long yen as we move into the new year. Pound yen, euro yen, dollar yen, I only wish to sell. Why? It is because of differentials amongst monetary policies. Where am I doing business? Now you apply technical analysis. We don't do it the other way around. What you can do, usually if you visit the book, let me show you. You can go here, sorry, there you go. If you visit the book page, it's right here. Apply global macro analysis and supercharge your trading performance. You can find more about this, but we have a special offer. It's right here. This is exclusively for TradingPit. We offer a 50% discount. And what we have done for $12.50, we offer the book together with free videos that we explain how to do things. And this will give you a concept of how to apply global macro in your trading. So 50% off, you just click, there is a special code that you can use, and you will be entitled to an exclusive 50% discount when you apply the coupon. I'm just going to pause for a second and ask you if you have any questions. Let's go ahead, anything you wish to ask about global macro trading. If you cannot find the link because somebody is asking, Alex has sent on the post his email, aspiotis@thetradingpit.com. You can see this inside the chat. Please send him a message and he knows where to find me. And you will have access to this link that is exclusive for the Trading Pit. Probably you have also received an email about this, and you will have access to this 184-page book on global macro that explains how to apply global macro analysis and supercharge your trading performance. And this is a practical step-by-step guide for traders. And we have this special offer exclusively for Trading Pit. So I'll just give you some seconds to see if you have any questions. Please let me know. Anything about trading, about your trading plan, about how you execute. I think the easiest way to trade if you are new to this is, let me go here. I will switch to a slightly higher time frame. I will use, for example, let's use two hours. It is important to pay attention to support and resistance. So when the price is hitting a support level, but you think it is important, and stays there for a while, you see in the short term, it forms a consolidation. Then you see it's moving up. Why do you think Euro, with all the problems in Eurozone, reacted like this and jumped higher? Why do you think? This happened because of the Fed decision. This happened last Wednesday, FOMC. They were more accommodative, less hawkish than expected. So we had a reaction, many stops taken out in this process. It goes to resistance. Shall you sell into resistance? Should you go the other way around? I was waiting until Friday morning personally, and I took a short when it broke outside this range. Why? Because the manufacturing PMIs came out and they were, as expected, worse. We knew that the European economy is not doing well. The PMIs came worse, sold, but I took profits. I'm not waiting for this to go all the way down. Why? Christmas is approaching. Liquidity is going to be thin. The markets are going to be closed. You have a nice profit. I mean, we made money on the way up, make money on the money down. Okay, call it a day, move on. I wish also to show you here, dollar yen, this real account. There you go. Euro yen, dollar yen. Every time it hits resistance, down, moves back up, resistance, down again. If you use Bollinger Bands, if you use moving averages, Fibonacci, support, resistance, anything you can imagine, the resistance is going to work. Why? Because of the fundamentals. There is now a divergence between the Bank of Japan and the Fed. This is why this is working. Maybe in other occasions, you might say, well, we are going to create a system and we will sell into resistance and it will not work. And you think your system is rubbish. No, your system is not rubbish. You must use your system, your technical system at the end. The decision to buy or sell is based on fundamentals. So this is what I wish to say. I'm just going to give you some seconds just in case you have any questions. Please let me know. Sorry, let me do this. This is the book. If you have any questions, you can visit Fotis Trading Academy or you can send a message to Alex at the Trading Pit. Please let me know if you have any questions at all about trading. You can, there is a chat box inside Zoom. So please feel free, go ahead and ask me anything. Just give you a few seconds. Otherwise, if there are no questions, we'll call it a day. And you are going to see me probably again in the new year with a new webinar. I'm just giving you some time. Okay. All right. No questions? Okay. All right. I want to thank you for being here. Thank you so much for attending our webinar that is organized by the Trading Pit. Thank you, Trading Pit. Thank you, Alex. If you have any questions, if you wish to reach me, please contact Alex at Trading Pit. And as I said, he knows where to find me. Thank you for listening. I see you all in another webinar. Bye-bye.